Hey everyone, how's it going? I'm George, I'm the ecosystem manager here. Trish is my fellow ecosystem manager. It's very loud. So who here has been to the House of Web3 before? Right on. So we're at Node. We're the initial team behind the graph. We wanted a physical space for the Web3 community, and we built the House of Web3. So I want to thank the 4 sponsors, TaxBit, On-Chain Index Ventures, SFOX, and Valmar Capital. So without further ado, I'll let the panel take it from here.
All right.
So just to be clear, we are Lord of the Rings dorks. So Valmar Capital is from the Lord of the Rings, Vylar. So that's where the name comes from.
Awesome. So before we jump into our conversation today, understanding Web3 as an asset class, I just wanted to get a show of hands. How many of you in the room, this is your first crypto Web3 event? You don't work in this space yet. You've just been curious and you found this event. Anybody here, like, don't be shy to raise your hand. So I'm going to assume everybody here already is deep in this space. So raise your hand if you already are working in Web3 crypto in some capacity.
Woo-hoo.
All right. And maybe there's one of you that just kept their hand down and is not sure, but I hope that this session will be informational. I'm really excited about it. Because it's a little bit smaller than usual, I hope that this can also be conversational. So we will have time for questions at the end. And if you have a burning question that has to do with what we're speaking about, raise your hand. Maybe we can also answer it while we're chatting. But without further ado, I want to thank Edge and Node and House of Web3 for letting us put on a panel like this, and also Valmar Capital, as well as Travis, my colleague from SFOX, coming up from LA, and also New York, Palo Alto. You guys traveled far for this. And I want to basically start with just the intro. So if each of you can start, we'll start with Luca to my left.
Okay, Luca. So I'm one of the co-founders and chief operating officer of Valmar Capital, a portfolio, an asset manager, multi-strategy, multi-manager hedge fund focused on digital assets. 25 years of experience in TradFi, crypto. I got into crypto a couple of years ago, and was previously a CEO of a family office, launching a hedge fund, and one of the co-founders and CEO of a Harvard spinout from 2017 that raised about $1 billion.
Yeah, and partners with Luca, Joe Cox, head of business development at Valmar Capital. Also deep background in traditional finance for about 10 years, working for a top 100 global family office, launching a myriad of businesses from funds to various strategic investment initiatives, particularly focused in emerging markets, but involved with digital assets since 2018, having launched a delta neutral high frequency trading firm, Exponenti Capital, raised that up to about $125 million. And really taking the next step here with Luca to go the multi-strat, multi-manager route, which we firmly believe has many advantages that we'll get into on this panel.
Hey, I'm Travis Perez. I'm one of the account executives at SFOX. SFOX is a prime dealer in the space. Work with both businesses and individuals, providing a institutional level platform for secure trading and custody. Prior to that, I was in tech, a couple of SaaS companies. Prior to that, I was in wealth management, mostly working with high net worth individuals on the structured products and MLP side.
Awesome. And I'll do a quick mini intro. My name is Sarah Tulin. I also work at SFOX. I head up the sales team. Prior to that, I worked at Routefire, a algorithmic execution trading platform that was acquired by Coinbase. Prior to that, it was SaaS, hardware companies, and my first job was actually in a neuroscience lab at Stanford. Turns out science wasn't for me, and I've been in crypto ever since. I wasn't sure if there was a question there. So I wanted to kind of also just hear everybody's first story, I guess, if we can, in a couple of sentences, like how did you get into this space? We did mention a little bit what you were doing before, but like what got you excited about working in this space?
For me, it was, I worked, it was after 20 years of the beginning of my career, I was in TradFi, really building hedge funds and targeting returns of, low single digit, low double digits rather, and low volatility. And so I remember as I was winding down the fund from Boston, a friend of mine just was bugging me about, a software developer was bugging me about crypto. And it wasn't until he showed me a trade that he made. It was, I think he bought something. I can't remember the name of the token, but he bought something at 20 cents. And then ran it up to $40 and made a few $1 million. So I said, okay, I'm in the wrong business, the wrong asset class. So I started being interested in that space, and a few months later, I decided to make the transition, and never look back.
Yeah, I think, the details of the story are a little different, but like the general themes are fairly the same. My background was launching a myriad of emerging market businesses, across a whole spectrum, financial, real estate, construction verticals. And so in 2018, a gentleman who I'm still very close with, who's, one of the smartest traders I've ever encountered, gentleman who was, trading for Paul Tudor Jones when he was 16, came up to me and said, "Hey, we got to launch a hedge fund in digital assets." And I was like, "What the hell are you talking about? Like, I'm building houses in Nigeria." But when somebody that intelligent comes to you, you do your research, you understand the opportunity, went down the rabbit hole, and still here and not going back.
Yeah, mine's is a little weird, but my first kind of introduction to crypto was walking into a university friend's dorm and seeing them in their underwear in just like 110-degree heat mining Bitcoin. And so like I let that go for a couple of years, but then later on, I was in wealth management, was dealing with a lot of the operational side of it, especially when it came down to any type of money transfer. Always a huge headache. We had, the hurdles of the weekends when banks closed. Obviously, international wires take a little longer. Ran back into Bitcoin at that time, and I'm like, oh, this is great. 24 hours a day. It's always visible to everyone. It's ledgered immediately. Maybe I should look more into this industry, and kind of fell in love with it on the personal side. After I left wealth management, I was looking for another industry because I couldn't really deal with kind of the restrictiveness of the TradFi industry. Fell back into crypto on the professional side, and just like since 2018, just been around, on the lending side, on the trading side, custody, all around the place.
So I see a common theme here, two common themes. One, everybody's introduction so far is quite different than the next, but two, everyone feels, they're here to stay, and they're really excited about the space, which leads me to my next question, which is, given that we've been in a bear market for quite some time, what opportunities do you find promising in this space? What do you expect to develop over the next few months to year?
Well, we have been in the space of, in the hedge fund space for a while, and we see, we see this space as a terrific opportunity to find alpha, uncorrelated alpha, and inefficiencies that are simply not there in traditional TradFi. So we have been, again, for decades in TradFi, and it is really hard work to generate a fraction of the returns that you can find in crypto, and that is why a lot of the TradFi people and talent that we see are actually moving into the space, because most of them, a lot of them are actually applying similar strategies that they were applying, at Millennium or Balyasny or some big hedge funds. Only they're getting multiples of the returns, and sometimes even lower volatility. So this is what it's exciting. It's exciting for me, and obviously it's a great timing as well, because we have been through a bear market that is was painful, but it's not very dissimilar from the ones that we had in the past, two or three times. And we think that the worst is over. And so in terms of development, we see, there's certainly a lot of uncertainty still at a macro level and in the industry, but certainly a big opportunity for people that get involved in the space right now.
Yes, I mean, in terms of it being a bear market, I think the opportunity has to be looked at in a kind of longer lens. So your timeline needs to get a little bit more extended. It's really apparent when you, let's say, go to a conference or anywhere that's going to have a lot of booths or projects that are out there kind of promoting themselves. You go back a couple of years when we were in the full bull market, most of the things that you saw at a lot of these Web3 conferences were DeFi focused, where, massive returns, massive yields all at once. Now you kind of go back, and instead of those types of projects, you see more infrastructure plays. And I think that's kind of a smart way to look at it. It's like, okay, we're in a bear market now. You build now, get the groundwork set up. And then that way, when the excitement comes back, when people start to adopt again, because they've kind of gotten over, some of the unfortunate circumstances that occurred over the last year or so, we'll be ready. And the industry itself will be ready. It'll be better prepared to handle that type of influx. And, my hope is that, people just watch their risk management while we're doing that.
You said it right. That's what I'm excited about, is the risk management portion.
Yeah.
We just saw, 50-60% of the funds get wiped out in the past year. People playing the short game, getting greedy, not diversifying. So, I think these are hard lessons that have to be learned by the market for us to mature space, right? That's why we're doing the multi-manager, multi-strategy, because we have evidence that the single strategy and the fund of funds aren't battle tested, through the roughest marketplaces. So it's screaming out for innovation, and innovation that's particularly focused on risk management.
Yeah, that's definitely, I think, everyone's top of mind is, how to manage risk management, where that clarity lies as well. And I'm curious, this question's more for Luca as well as Joe on, with so much volatility in the market, how do you manage risk? What is your approach, when it comes to risk management?
Well, in general, our approach, the approach is to, certainly diversify. It is, diversification, whether it's TradFi or crypto, is a battle-tested solution. Spreading the risk across different strategies, positions, portfolio managers, and I think you basically are able to achieve comparable returns at a lower volatility, lower risk.
And if you don't believe Luca, believe Ray Dalio.
And this is true for TradFi, and so the way we also approach to go beyond that, we approach the problem is through centralization of the risk management. Talking about risk management, centralization of risk management and operations. So we're creating a platform that enables, on the one hand, portfolio managers and strategists to be plugged in, but most importantly, for us to have a complete visibility and transparency over what's happening. So we have knowledge of what's happening at the portfolio level, at the strategy level. And because we maintain control over the assets, it's not a fund of funds, we have control of the assets, we're able to pull the trigger, reallocate funds from one strategy to another in a dynamic fashion as the market evolves. And that's how we approach the problem.
And not to oversimplify it, but, different strategies have, different levers that we're looking at. But at the end of the day, it's really exposure and liquidity management, right? So it's like, how do we have visibility of exposure, liquidity across each position, across the totality of the book, 24/7, 365, and can stop that trade, stop that particular strategy, or stop the overall book on a dime.
Awesome. Now, this has already been such an interesting session. Continuing on, Travis, can you share with us a little more on SFOX and how the platform supports traders, funds, and different clients?
Yeah, sure. So what we've effectively done is built a platform that allows you to securely custody and trade across global markets using one account. So instead of having to kind of spread your capital around to, let's say, a bunch of different exchanges, OTC desks, through one account, you have access to all of them. We aggregate the liquidity. And especially right now, when you see a lot of these kind of big market maker players leaving the crypto space, or at least pulling back on a lot of these initiatives, liquidity becomes a huge factor in making sure that you still profit and keep your P&L at a good level. And if you can do that via one account, you can get your loans from one account. You're able to eliminate that slippage, get best price execution. Over the course of the year, you're going to see tremendous results that are just boosted with the type of structure that SFOX has, where it's kind of an all-in-one box that helps you manage your assets.
Awesome. Moving on, I am looking at these questions. I know we did want to cover a bit more on risk management. We kind of talked
it's
about
my favorite topic.
Yes. We talked a little bit about diversification and being able to control funds, pull the trigger when necessary. Are there any other steps or things that you're taking into consideration when it comes to risk management?
I mean, there's so much, right? We could be here all night speaking about risk management, but if, just to keep this audience friendly, if, we could highlight some broad lessons coming out of, the last year and a quarter. First and foremost, risk management matters as much as yield generation, right? As an investor, it's not the worst thing in the world to give all your money back, right? So protecting of capital is investment manager job number one, especially paying attention to those risks that relate to the offshore exchanges that you're trading on. That's where your number one maximal loss threshold is. So, really having a strong program controlling that. We've learned that taking shortcuts now is going to lead to pain later. A lot of these funds that blew up, some of them my friends, right? Companies that blew up. I knew that they were having to do what they had to do in the early stages of growing business to grow a business successfully. But sometimes those entrepreneurial shortcuts don't always necessarily comport with, a long-standing business. And I think we've seen some of that get sucked out in the last year. Traditional risk management approaches work. There's no need to necessarily reinvent the wheel on the methods that you use to, sort of maximize your active trading risk management. What it does necessitate, though, is a deep understanding of what that rigor is and how to apply it. And then understanding sort of the bespoke specificity of digital assets, because, there's a different bump and a different curve, right? There's 24/7, 365 markets. There's increased counterparty exposure that we talked about. There's increased black swan risk, right? There's an incestuous nature when a bomb goes off in digital assets for that to spread rather far and fast. So, the same disciplines need to be applied just in a bespoke way to those crypto-specific niches. What else? Specialization matters, right? You can't boil the ocean all at once. You have to pick and choose what it is. There's a lot of opportunity out there, but build the solid foundations of your core competencies before you start to scale. Be the best in the world at your business before you start tacking other stuff on. Hodling. It's not an appropriate strategy for institutional investors. It may be an appropriate strategy for your personal account because you're a deep believer in this space and you're willing to eat that vol and take the ship down as close to zero as you can. Investors with real mandates aren't. That's not a strategy. Macroeconomics matter greatly. I mean, we're seeing that right now, right? The more digital assets and the traditional finance world come closer, the more they're going to affect each other. We're seeing how currency pressures are affecting digital assets right now. And, I think what you'll see this leading to a degree, Sarah, is look, at least with the investment managers I speak with, it's all we speak about now is risk management, right? We speak about it all day, every day. And and we're sharing information about everybody who's out in the space. So if you're a counterparty or a business who's not being seen as comporting themselves in the right way or being a risk to the environment, it's being spoken about.
Yeah, no, definitely. I think it is something that the space is unique in that it's quite small. Everybody knows everyone. And if you've been in the space more than 6 months, you're already somewhat senior in the space, as it's such a new and evolving space. You did mention
And most of the fund managers know each other from previous work.
Yes, I see that all the time. We have some on the team at SFOX who come from TradFi, and it's always fun when I feel like they come over and they're in crypto for the long run, coming from TradFi. So I'm curious. You did mention institutions. What are your thoughts on unlocking institutional capital? Hodling isn't necessarily a strategy for large institutions. I think we had institutional players coming into the space. Then a lot of different events happened in the past year that caused them to kind of back away from the space. What are your thoughts when it comes to unlocking an institutional capital?
So there's certain things that are somewhat outside of our control. Regulatory developments, for example, that to us is a big hurdle, and we can talk about that. What you can do, or what fund manager can do, is to structure the fund to be institutional grade, because all institutional grade funds are able to attract institutional capital, and that means providing a strategy that is diversified. Risk management, again, laser focus on the risk management and rock solid operations, and scalability as well, right? Because we see in our work, we approach and talk to hundreds of managers. We see most of the managers out there, aspiring to launch a fund, but the capacity of the strategy is $20-30 million. No institutional investors will give you money because one, they write tens of millions of dollars type checks, and two, they don't want to be a big percentage of the fund either, and therefore you had to be at least $100-200 million. In order to be that, you have to have strategies that are scalable enough that if you deploy capital, the alpha doesn't go away,
and that your operations doesn't collapse on itself.
So these are just some suggestions.
Yeah, definitely. You mentioned regulation, and regulation is an ongoing concern in the space in general. It's always evolving. How do you navigate, when it comes to regulation?
Well, we're doing what the other fund managers are doing, exploring non-US jurisdictions. So we've been talking to the UK, Cayman Islands, Dubai, Abu Dhabi, Hong Kong, and really trying to pick where we want our management company to be. And that's the result of the ambiguity and the lack of clarity in regulations at the moment, pushing people out of the US. And then we see that, as I mentioned before, as the key, one of the major development for sure, to unlock institutional capital, because if finally the SEC and the Congress will get this right, and we believe in the long term they will get this right, because the US in the end always does. That will cause certainly a repatriation of managers, capital to come in, and institutions to go into the space.
Yeah, Luca, just one thing I'd like to add quickly is with respect to everything in digital assets, right? The velocity of evolution and change can happen super quick. And so you have to think about the present and the future. So with the present, right, it's do the planning. The various regulatory bodies in each country will speak to you. We've been on the phone with them. There are lawyers who'll get on the phone and will give you all the information you need to know, right? Off the top of if you're going to get 5 or 6 things out of it, do they have a strong regulatory framework? Is it somewhere where your investors can exist? Can you get talent and service providers that you need there? Does it operate under English common law? Those type of things kind of matter. And then the only other thing I would add is once you put that setup in place, understanding that the regulatory environment could still change some more, make sure there's some flexibility baked in there that if you need to make a change from the jurisdiction you're in, that you can do that without having to pull your hair and your teeth out.
Yeah, I mean, for us on the kind of service provider side, being preemptive in terms of the actions you take based off of what you believe the regulatory climate's going to be like in the future is pretty important. So, a great example is, we turned our custody solution into a trust entity. We gave it a bankruptcy protected structure. We did this, prior to kind of the big blowups that occurred over the last, however many months. But we did it because we saw kind of the writing on the wall of if the government and regulators are going to be looking at crypto companies as kind of a risky play for people to participate with, you want to not give them the option to question what you're doing with the funds, how you're protecting those clients. You want to make it extremely clear to both the clients and the regulators that you're taking steps that are even above and beyond what they would probably ask for in the future.
Which, by the way, Sarah, to your question about things that we can do in this space, we have reputation that really needs to be improved. So belt and suspenders, everything, right? Because, we work in this space. So we, of course we're good and we're doing everything above board and we trust ourselves, but it's different to the semi-informed. It's different to institutional investors who have boards that they report to. And so, it's our job to go over and above to repair that reputation, which sometimes I think is more damaged than we think sitting deeply inside the matrix here.
Yeah. Well, we've spent a lot of time talking about risk management, navigating the regulatory space. I'm going to switch gears a bit, and I'd love to hear from all of you on the 2 to 3 major themes that you expect to unfold in Web3 in the coming months here. So a little bit more of an open-ended question, but a little bit outside of risk.
So for me, maybe this is an answer that some of you guys won't like, but I see more TradFi, and in particular as the asset in the asset class in the asset management industry. As the asset management industry matures up, I see more and more of these TradFi talent and people coming into the space, more investors allocating capital to the space, and regulators regulating in a more clear way, bringing compliance levels and standards on operations, risk management, everything else that are similar to what they are accustomed to in traditional finance, and we'll see more and more crypto managers look exactly like regular asset managers. So that's and from the ecosystem, it'd be good to hear your opinion. But from the ecosystem of service providers, clearly there's been a lot of problems in 2022 with certain categories of whether it's custodians, exchanges, but there will be a trend, in my opinion, toward consolidation and institutionalization of these operators.
Well, then there has to be, because it comes back to that counterparty risk, which everybody's got their eye on now, right? So if you don't have ACE custodians, ACE prime brokerage solutions, lending solutions, banking solutions, it all falls apart.
Yeah, I completely agree on that end. In terms of the TradFi businesses coming into the space, that's inevitable. A theme that it's kind of exciting to think about, but I think it's going to be a little bit different than what we're used to. I do think there's going to be a little bit of conflict between Web3 and maybe not TradFi, but traditional markets. So right now, I'm sure I was speaking to somebody about this earlier. I'm sure you guys have bought tickets from like a Ticketmaster or one of those third-party vendors. You get to the end and all of a sudden you're getting hit with, let's say, 70% in fees. Web3 is a great tool to be able to fight that, but Ticketmaster isn't going to go down without a fight. And so I'm kind of excited to see how those play out, because how Web3 is kind of democratized in communities, I think there's a lot of ingenuity that comes up when there is that type of conflict between the traditional companies and then, Web3 focused companies that are trying to solve that particular problem.
To your point earlier about like the utility of instant settlement, isn't BlackRock's biggest product a settlement product?
Yeah.
Right? Yeah, they're not going to go down without a fight on that one. That is their business, right? And I'll give you one, and I'm going to stay away from one of the ugly R words. I won't say risk management other than that. I won't say regulatory other than that. We'll go to energy. I think we see another rising buzzword in the financial space is ESG, right? It's becoming a focus point, and I think the energy use of digital assets will come under scrutiny at some point in time, and there will be an exploration as to maybe how to bridge the gap with certain renewable energy resources.
Awesome.
Volcanoes.
No, I'm thinking more back to my days of real estate development in Nigeria. The problem with solar energy is you can't feed it back into an electrical grid. But what if you could pump that excess energy into mining operations, and then you suddenly make the whole infrastructure more financially viable?
Well, that's actually something that's happening right now with, let's say, the Texas power infrastructure, where there isn't very many industries where you can flip a switch and in seconds power gets rerouted to a different place. With a kind of power grid like Texas that's secluded from the rest of the U.S., they run into issues where, okay, once we need extra power, we can't really pull it because we haven't been producing it. It takes a while. But what if we send that excess power when we're not using it to a miner, and they can go ahead and, if we do need the power, flip that switch, we can take it. That's immediately a use case that wasn't thought of, let's say, 3 years ago. But at this point, it's helping Texas manage that conflict or whatever.
Well, I mean, at the end of the day, mining is just energy arbitrage, right?
Yeah.
And to your question earlier, Sarah, you're talking about opportunities that are still out there. And we talk regularly with a fund that I can't give you the name because we want to get credit for it. So if you come talk to us afterwards, maybe we'll pass it along. But that crushes these bear cycles, because essentially what they do is they go to West Texas. They pull out new 3, 4, 5 year energy contracts at dirt cheap prices, and then they just they lock it in.
All right, I have one last question, and then we'll open up for the audience. But what key milestone do you believe needs to occur for wider adoption? I feel like over the years in crypto, we kind of make a couple steps forward, and then we get sent way back to the beginning, and everybody that's kind of looking for an introductory place to begin in the space gets scared and scales back. But what do you think needs to happen for people to start feeling comfortable, for us to not have to feel like we're explaining to our friends not in crypto why we're still here?
So for our industry, as I mentioned before, developments on the regulatory front is one. But for me, the main doubt that I still have as of 2 years ago was really the fact that the asset class or the technology has struggled to show real use cases that that really resonate with people, the common people out there. So not just the degens or the developers. And it's understandable because a lot of the infrastructure has been built, and that kind of goes behind the scenes, and it happened before with the internet and email and everything. So, but I think a key development for me is really the development of technology and applications that can truly disrupt everybody's life, and disrupt industries, and people can see and touch and understand what the technology is about, because that will turn into an amazing investment opportunity.
Yeah, if I'm thinking about key developments and staying away from those 2 R words again, maybe one that I'll just throw out there is indexing. which is to say, a lot of managers in this space have struggled to communicate their risk-adjusted performance relative to other investments. And when it comes ultimately to institutional investing, basically you need to be able to go in there and convince them to swap out one investment for another, and it should be as like for like as possible. So really strong indexing will allow institutions to understand the risk-adjusted comparison of really what they're involved with.
Yeah, well, I mean, I agree with Luca that the number one thing is regulatory clarity. But then in the use case side, I don't necessarily think that people need to know exactly how things are working, because there was a lot of technologies that have come out over the past couple of decades that have become kind of integral to our lives, but most people don't even understand that they're working on the background. I think a lot of Web3 and kind of the blockchain space has that ability to be kind of that back end infrastructure where we'll still be growing and being successful, and people may not even know that the industry itself is what's affecting that change. It'll just be more efficient, cheaper, make people's lives better, and we'll keep growing.
By the way, most people's financial exposure to this will end up being passive, right?
Yeah.
Retirement plans, 5% allocation to a traditional, 60-40 bond portfolio, that type of stuff.
Awesome. Well, I want to open it up to the audience as well for questions. I don't know if we have another mic to pass, but
I may not need a mic.
okay, maybe you don't need it. Okay.
I'll be mic guy.
It's been a great panel. My name is Tanvir. For a long time, 15 years, I've sold software to large enterprises. And it's not easy to get a big bank or an insurance company to give up a legacy solution and buy my product, even though it was a market leader. In your world, selling to institutional customers, I'm thinking is very hard. So can you tell us a little bit about your sales cycle, right? How do you build trust and how do you win your customers over? Right?
Yeah, I can maybe answer partly for SFOX and then Luca. I think it's, a lot of it is there's different types of clients and customers. There's customers who get the solution on board and they can be up and running on our platform within 2 to 3 days. Then there's large banks. We do have a partner, Broadridge. Broadridge is a large institutional customer that took several months. And it was more about helping them understand the full flow of, what do they want to do on our platform? How can we provide it? It was a lot of DDQs, a lot of KYC, a lot of basically educating those partners, even providing actually to one of their bank partners, a full blockchain 101 class. So I think it actually starts with education before the sale when it comes to these larger clients who they know that there's a demand, they know they need to prepare, but they actually first need to learn before they get comfortable.
So in our world, so institutional investors, there's not many of them right now that are investing in the space. So, but I can say from previous experience, the sales cycle is always extremely long. So either you have some sort of a existing relationship, and even that takes months before you can close. In our case, a subscription, injection of capital into the fund takes months. A lot of due diligence, operational due diligence, all kinds of due diligence on investing side and background checks, and then
Clean the garage.
Yeah, sure. And then even when you pass due diligence, then they put you on the radar, and that could take forever. I mean, then you have the Japanese investors that literally, could take 3 years before they do anything.
But if you drink a lot with them, it might.
That's required.
They're always polite and say, but they're not. Then they become sober and they're hard to pull the trigger. So it's a long process, and in crypto, it's right now it's almost non-existent.
Yeah.
Right now, you need, like on the investment management side, if you're raising capital, you're really raising capital for the part from family offices, high net worth individuals. I guess I would also split the word institutional and crypto into two categories, right? There's sort of like TradFi institutional, and there's almost sort of a crypto institutional now. So you can get some cash crypto institutional, but like I mean, I can tell you about like when the stablecoin debacle hit last year. I was actually sitting on a panel at the AMA conference in New York. All of the institutions were there. Like I was feeling the palpable energy. I was like, holy shit, we're 6 to 8 months away from this like actually cracking. And then, we have the, tether start sinking and people's faces turn green. Like so watch it happen in real time. And that pushed us off in like 12, 16, 18 months easily.
Yeah, I'd like to add to what Sarah was saying, but also to kind of emphasize that if you're going to be doing kind of a institutional style sales process, at least as a service provider, you have to be able to adjust to what the market is demanding at any given time. So like there are crypto native companies that can manage their front end, their wallet infrastructure for their clients, everything that comes with that, the regulatory burden. But then there are others that maybe are a little bit strapped on resources, aren't necessarily as crypto native as you would think. Like a good example would be credit unions. They would like to offer to their members crypto services, but they don't want to be in charge of any of the things that I just mentioned. So, in that sense, we've like adapted to offer an infrastructure product where effectively we take the responsibility for having those wallets, building out the infrastructure, getting the KYC AML for them. And all they really need to do is have the front end UI connection to be able to offer it to their members who clearly want this as a product, but they don't really want to take on that additional risk.
Quick follow-up question. So you have some credit unions as customers?
So we are working on it right now, but
I've done business with them. They work very slowly.
Exactly. But like, if it wasn't for the fact that we oversimplified the product effectively, a lot of them don't even want their members to be able to withdraw the crypto. They just want them to be able to have it to kind of diversify their assets. So we've kind of adjusted the product for them specifically. And now they are much more inclined to speak with us and continue the conversation. But yes, you are right. They are not the fastest when it comes to. Yeah, exactly. So we're hoping that it turns into a pretty big market for us.
Got a few questions.
Hi, thanks. How do you define fundamental value of Web3 assets?
Well, that is a good question, because it's a question that I have asked myself, and fortunately we're not token pickers. We pick managers that among the different strategies, discretionary long managers that do fundamental and research-based, have a fundamental research-based approach. But I think I don't know if there's anyone out there that has a clear idea of what a value of a token is. We have standards and models from TradFi that are based on projected cash flows and dividends, and really the earning ability of the entities, which is somewhat missing in most cases in crypto. And therefore, I think the entire industry, and we have the head of research here, Falconex, maybe he can weigh in, but the entire industry is struggling to, in my opinion, to find real models that people can really adopt.
At least in my opinion, this is purely as kind of on a personal interest in Web3. If the tokenomics make sense, if you can use them for whatever protocol you're interested in, and you have a big enough community to support it, I do think there is fundamental value, because putting it in, let's say, a gaming perspective. So CSGO had a tremendous secondary market for a lot of their skins and products that people would trade in between. At the end of the day, they're just kind of virtual assets that they gave value to. But it could be the same thing with like physical assets, like Pokemon cards or anything that has that innate ability to get somebody to want to commit to it as kind of a long-term interest, and allows them to really enjoy life, because that's, at the end of the day, that's what we're doing, right? We're going through life, we're finding things we enjoy, and then if we do, we keep doing them over and over again. Gaming, great example.
Yeah, the only thing I'd emphasize responding to that question is you kind of heard us mention earlier lessons learned out of the past year, and hodling, not a strategy, right? Why is it not a strategy? Because I can't fundamentally tell you where the value's coming. I don't know, when that's going to zero, when it's going to rip, right? I don't know anything about it, but I can tell you about market making. I can tell you about statistical arbitrage. I can tell you about funding rate arbitrage, and I can literally show you the 20% opportunities that you can drop $100 million into for 15 minutes.
All right, I know I saw another question.
It's for Luca and Joe. What are the strategies in your multi-strategy approach, and what is sort of the combined investment mandate of the fund?
So the strategies, we have a very wide and broad range of people. The fund is now launched, so we're talking about a pipeline of managers that we have built, and this ranges from DeFi and maybe strategies, discretionary long short, to systematic long short. We have statistical arbitrage strategies, funding rate arbitrage.
We've got, automated, we've got systematic long short, discretionary long short.
But so the idea is to put together a portfolio that has a portion of systematic, some discretionary, portion of directional, some market neutral, some DeFi and CeFi, and there's we find a lot of talent and a lot of opportunities out there, and the diversification obviously brings along the uncorrelated alpha that we were talking about before. So they're just absolute return.
Risk-adjusted return, right? So we're shooting for 30 to 50% annualized returns with like 15 to 20% volatility in there, right? So like that's the name of our game, is to go out there, cull the best strategies in the world, put risk management bumpers around them, right? And then allocate that capital in a strategic way with our little hedge book on the side. That we can kind of play off of, and keep our vol and keep our yield targets in range. To your question about like what is our mandate, it's really to offer the broadest diversification of the best strategies and digital assets to our managers. So that being said, there are certain strategies that might not necessarily fit into the portfolio right now because of maybe some shortcomings at the moment, but that doesn't mean that those aren't strategies that can't fit into the portfolio in the future, right? If we're going to give that best return to our investors and give the best exposure to the asset class to them, we have to meet our managers where they are. And that's why we're building this platform out in the Millennium style, right? Like the way we really have two client bases. We have our investors and we have our managers. To be able to give the best managers to our clients, we have to give our managers something too, beyond just capital.
Any other questions? We got a couple more.
Joe, you mentioned something about your managers kind of capping out at $20-30 million, a lot of them that you guys run into. And obviously in the top 20 market cap, I think Chainlink right now is 3.3 billion. So if you're dealing with a lot of managers that can't get over that $20-30 million crest, but there are a lot of them that aren't they going to be playing in that same top 20, top 25 pool where you have 18 managers and they own 16 of the same stuff? Is that a challenge?
Well, so I think it can be for particular strategies, but so what I might say is for your groups that are running higher scalable strategies right now, they're probably market neutral, higher frequency, and towards the market making end. As somebody who's done that before, like, dear God, you don't want to start your life doing that as a small fund. And we're getting to the point now where like those are big enough that that's a pretty big roadblock to getting involved in there. So like a lot of the, so, okay, if we were to say that there are so we're building this pod structure, right, whereby we can provide consolidated technology, ecosystem, capital, plug in, you focus on your alpha and gamma and your risk management. We add that extra layer around it and go, right? Because when I did this the first time, we had to build out our technology. It took us a year. We were sitting on our trades for a year when we could have been capitalizing on it, right? So like this is real value for many traders in the space. And the two profiles of traders that we're finding that fit that pod value the best are either, you know, sort of your maybe your very traditionally healed trader, you know, a vol trader out of 0.72, you know, maybe running the VIX there for 15 or 20 years, who's then reapplying that strategy. They've been doing it maybe for a year and a half in the garage, right? They don't give a shit about starting a fund, but they would. If you gave them the keys to the car, they'd go, and they're doing great. And then there's this sort of crypto native profile, right? Almost like a younger rocket scientist, you know, type who's been involved with the space and, you know, trading since they were 12 or 13. You know, we talk about different fundamental metrics who are seeing the space differently than you and I might see it, and are seeing alpha differently because of that as well, right? Hell, if they're hitting it out of the park, my job isn't to slow them up because they're smarter than me, right? It's to give them an opportunity to hit it out of the park. And so these are really the two like classes that fit perfect into the pod structure. These are two classes for traders that we're finding that are the best, that aren't being serviced right now, and investors don't even have a shot to invest in them. So,
Thanks.
I think we have one more question.
Hi, thank you. This is a question mostly for Luca and Joe. You guys mentioned a few things. I think Joe actually kind of almost answered my part of the question. But Luca, you mentioned scalable investment strategy. What are the kind of characteristics that define a scalable digital or Web3 asset class strategy? What are those kind of items? And then the follow-up is, how does that manifest in an operational process and an operational procedure that won't collapse? What are those characteristics?
Scalable is simply, you know, it's common sense is size. And then, so our conclusion operating in the space is that, you know, in order to achieve certain ambitions and grow something at a you know, multi-billion-dollar level, if you unless you're taking, you know, long positions like Pantera or these guys, then you have to put together a number of strategies. And, you know, you achieve diversification, but also that allows you to be effective, to generate alpha with a collection of strategies that in and of themselves are not scalable. But, you know, putting them together, you achieve certain scale. Yeah, that's right. Clearly, that is a complex process. To go to the second part of your question, operationally speaking, you know, you have to create an infrastructure, a team, an infrastructure, and technology that is able to home all these strategies. You know, because our objective is for each one of them to be able to just, like Joe was saying, plug and play, right? You plug in, you just trade, and we take care of everything else. And that, operationally speaking, is not easy.
well, but there is some good operational infrastructure that's in place right now, right? You know, we talk about improvements being needed on the prime brokerage and custodial side of things, but there's good audit services out there right now. KPMG will give you a good audit if you have a good business. You know, there's several strong fund administrators out there right now, which really, you know, the fund administrator from an active management perspective, especially if you're trading at any type of higher frequency, will be your best friend in the entire world. And even though we kind of came out of that Silvergate bank crunch, right? Look, there's other banks that are servicing digital assets the right way, and we'll give you a name of one right now that we like very much. Citizens Bank is doing a great job. So, infrastructure components are there. Others need to grow. You do need to have experience running a hedge fund because you don't just kind of figure that stuff out on the back end. And then it's a matter of once you know how to do it, you automate as much of it as you can.
A couple more questions and then,
I was wondering if are investors getting smart enough to start asking about whether or not you're self-custodying or using qualified custody and things like how are you sourcing liquidity? How does clearing and settlement work? Where's all the hidden credit risk?
we're definitely asking.
Yes.
And you better have answers.
But, I mean, you cannot have the perfect answer. It's impossible to be in the current state of the industry to satisfy the custody rule, for example. Can you have custody of your assets at all? Can you keep your assets at qualified custodians a lot of time? It's not possible. So there's ways for a fund manager to take that and have a pragmatic approach that works with investors. May not work exactly and technically for maybe the SEC, but works for the investors. You put in place strong compliance and policy and procedures to maintain control over who does what, who has control over what, who makes the decisions, who transfer assets, and everything. And but unfortunately, there's no. I mean, not even in TriFi there's a perfect solution. But especially in crypto, it's a bit of a compromise in a game.
So another question back there.
Yeah, I was going to ask about MEV. Do you guys have any plans in the future to support like MEV strategies or in general like block building?
Yeah, yes, we're talking to a couple of portfolio managers that are running these strategies. We find them pretty interesting.
Yeah, I'd say the most challenging thing with MEV right now is the scalability of MEV, right? And also just understanding the full liquidity picture. But our job is to meet the best managers where they are, right?
How do you put that in a fund structure?
How do we meet the best managers where they are in a fund structure?
How do you put a MEV strategy in a fund structure? Your fund admin is okay with hundreds of thousands of trades a month?
Absolutely. I mean, we were at my previous high frequency firm, we were doing millions a month.
Yeah, but on chain, you
There
got a fund
are-
admin who's cool with tens and
Yeah, and we
hundreds
can
of-
chat after, and I'll give you an introduction if you need. They're very good.
Awesome. Well, I think, I want to thank everybody for coming out tonight, as well as the panelists. I know this is second or third nice weather day in San Francisco this year, and you guys decided to come and learn about the digital asset space, excuse me. So I really appreciate that. I think we'll have some time to continue networking, and please connect with all of us if you have any questions or if anything comes up, we're around.
Thank you for moderating, Sarah.